There is a pattern in financial history that most people have never heard about, but it's happened 5 times in the last 15 years. In Argentina, $30 billion. In Poland, $50 billion. In Hungary, $14 billion. In each case, governments facing fiscal crises made the same decision: restructure private pension systems by transferring assets to state control. Not through gradual policy changes. Not through taxation, but through direct legislative action. Overnight, millions of people who had spent decades contributing to private retirement accounts found their money moved to government balance sheets. And here's the striking part. Every single time, the official reasoning was identical. We're protecting you from market volatility. We're stabilizing the system. This strengthens retirement security. We're acting in your best interests. The results? They varied. But in each case, the gap between what was promised and what was delivered created controversy that persists today. This isn't a story about conspiracy theories or financial doomsaying. This is documented history, reported by Reuters, Bloomberg, the Financial Times, and academic institutions worldwide. These events happened, they're in the public record. And understanding the pattern matters, because pension systems globally face the same mathematical pressures that triggered these restructurings. This is the story of what happens when demographic shifts collide with government fiscal policy, when the assumptions underlying retirement systems break down, and when nations make difficult choices under crisis conditions. Whether these choices were necessary reforms depends on your perspective. But the pattern itself is undeniable, well-documented, and worth examining closely. Let's start with the foundation, because pension systems weren't always controversial. They were built on assumptions that seemed rock solid when designed. Take the United States Social Security system, created in 1935, or Britain's modern welfare state, established in 1948. The premise was straightforward. Workers contribute during their productive years, and the system provides income when they can no longer work. The design made sense given the demographics of the time. These weren't savings accounts. They were transfer systems. Your contributions today don't accumulate in an individual account. They're paid directly to current retirees. The system functions smoothly when demographics remain favorable, when there are substantially more workers contributing than retirees receiving benefits. In 1950, the United States had 16 workers for every retiree. That is 16 people paying in for every one person taking out. The system generated surpluses. By 1960, that ratio dropped to 5-1. Today, it's less than 3-1. Projections suggest it'll reach 2-1 by 2030. The mathematics are straightforward. If you need $3 in contributions to pay every retiree $1 in benefits, and you only have 2 workers contributing, the system runs a structural deficit every single year. Governments facing this gap have 3 options: increase worker contributions, reduce retiree benefits, or borrow to cover the difference while hoping future economic growth closes the gap. Here is where the challenge intensifies. Demographic projections suggest future growth patterns may differ significantly from historical trends. Birth rates across developed nations have declined significantly. The United States fertility rate currently sits at 1.6 children per woman. Replacement level is 2.1. Japan is at 1.3. South Korea, 1.1. Italy, Spain, Germany, all below replacement. Based on these trends, demographers project the worker-to-retiree ratio will continue declining rather than stabilizing. This isn't theoretical speculation. It's observable reality. According to government accounting, the United States Social Security system faces a $13 trillion unfunded liability. That's the actual difference between promised benefits and projected revenue. State and local pension systems report an additional $1.4 trillion shortfall. Globally, the World Economic Forum estimated a $400 trillion pension funding gap by 2050. That's not 400 billion. 400 trillion. Approximately 5 times current global GDP. There's no plausible economic growth scenario that closes that gap through revenue increases alone. Which brings us to what happened in 5 countries when they reached critical fiscal tipping points. Argentina, 2008. The global financial crisis hits. The Argentine government, led by President Cristina Fernández de Kirchner, faces severe debt pressures. International borrowing becomes difficult. In October, Kirchner announces legislation: nationalize the private pension system. $30 billion held in 10 private pension funds. representing retirement savings of 9.5 million workers, gets transferred to government management. Officials called it the Sustainability Guarantee Fund. The stated purpose: protect retirees from financial market volatility. Subsequent analysis revealed the funds were used for various government expenditures, including infrastructure projects and stimulus measures. Research from FIAP, an international pension research organization, found that post-nationalization experience shows that the system's pensions and replacement rates have not improved, suggesting retirees received less than they would have under the private system. The restructured system appears to have delivered lower real benefits as inflation eroded, purchasing power and government funding priorities shifted. Poland 2013 to 2014. In late 2013, Poland faced European Union fiscal requirements limiting national debt to specific GDP percentages. At 57% of GDP, Poland approached the 55% threshold that would trigger mandatory austerity measures. Prime Minister Donald Tusk's government proposed pension reform legislation in late 2013, with implementation occurring in February 2014. The measure transferred $50 billion in government bonds from private pension funds to the state's social security institution. The mechanism: private pension funds held diversified portfolios, including government bonds and equities. The government specifically seized the bond holdings, canceled them, and recorded this as debt reduction, lowering national debt by 8% of GDP. The bonds backing retirement obligations simply disappeared from the national balance sheet. Future retirees lost approximately half their accumulated savings, though many didn't realize it immediately because the accounting was complex. Hungary, 2010. Viktor Orban's Fidesz party wins a 2/3 parliamentary majority. Hungary faces significant debt challenges and pressure from EU institutions. In December 2010, Orban's government passes legislation affecting 3 million Hungarians: transfer private pension assets to the state system, or forfeit eligibility for state pension benefits. Given the binary choice, 97% complied. $14 billion in private pension assets transferred to government control. Official statements indicated that 63% would go toward debt reduction. Government officials initially promised that citizens would receive equivalent credits in the state system for their private contributions. However, the National Economy Minister later announced that individual account credits would not be provided. The funds were absorbed into general government revenue. Ireland, 2009 to 2010. The Irish banking system faces severe stress during the global financial crisis. The government needs immediate capital to stabilize financial institutions. The source: the National Pension Reserve Fund, a sovereign wealth fund established in 2001 specifically to pre-fund pension obligations for the years 2025 to 2050. 4 billion euros deployed in 2009, another 2.5 billion in 2010. 6.5 billion euros designated for future retirement security, redirected to financial sector stabilization. Official communications described this as temporary emergency funding. Replenishment was discussed but never materialized. As Ireland's population ages and pension obligations increase, the reserve fund that was meant to provide a buffer no longer exists. Greece, 2010 to 2015. Greece's situation differed from direct asset seizures, but followed similar pressure patterns. Under agreements with the EU, IMF, and ECB, Greece implemented 12 rounds of pension adjustments. Benefits decreased by 14% for the lowest paid retirees and 40% for the highest earners. Retirement age increased from 60 to 67. Required contribution years extended from 35 to 40. The government eliminated 13th and 14th month pension payments, traditional supplement payments Greeks had relied on for decades. Current data shows 43% of Greek pensioners receive less than 660 euros monthly. Many extended financial support to unemployed family members during the crisis, when unemployment reached 27%. The pension system underwent fundamental restructuring to meet debt payment obligations to international creditors. 5 countries, 5 fiscal crises. 5 times governments restructured retirement systems under pressure. The playbook showed consistent patterns. But here's what makes this pattern significant. These weren't random events. They were reveals, moments when governments demonstrated what pension systems fundamentally are. Promises backed by future revenue assumptions rather than fully funded accounts. Let me explain the mechanism that enabled these restructurings. Traditional pension systems are supposed to be funded. Workers contribute money during their careers. That money gets invested. Returns compound over decades. By retirement, accumulated assets cover promised benefits. That's a defined contribution system, and it functions when assets remain protected and properly invested. However, most government pension systems operate differently. They function on pay-as-go structures. Current worker contributions aren't invested for those workers' future benefits. They're immediately transferred to current retirees. It's a generational transfer system, not an individual savings system. The government isn't accumulating assets proportional to promises. They're making commitments that future workers will provide future funding. When demographics remain favorable, this functions adequately. When demographics shift, when the ratio drops from 5 workers per retiree to 2 workers per retiree, the system enters structural deficit. Current worker contributions can't cover current retiree obligations. The gap between revenue and obligations becomes a funding shortfall. Governments facing these shortfalls typically employ 2 accounting approaches that mask the problem's severity. First, they assume optimistic investment returns. Many state pension systems in the United States assume 7 to 8% annual returns. However, bond yields currently sit around 3%. Long-term stock market returns, adjusted for inflation, average approximately 6%. That gap between assumed returns and actual returns creates unfunded liabilities that grow annually. Second, governments use elevated discount rates when calculating future liabilities. Higher discount rates make future obligations appear smaller in present value terms. If you assume 8% returns, you can report your pension system as 80% funded. Using a more conservative 3% discount rate, that same system might show only 40% funding. The actual obligations haven't changed. The accounting methodology did. This isn't necessarily malicious. It reflects political reality. Admitting true liability scales would require immediate, substantial contribution increases. Taxpayers would resist. Politicians would face electoral consequences. So systems use optimistic assumptions, understate liabilities, and defer the problem to future administrations. Until crisis conditions force action. Until the pension fund approaches insolvency and governments face binary choices: default on promises or restructure using available assets. Argentina, Poland, Hungary, Ireland, Greece. They all reached that inflection point. They all chose restructuring. Now, you might think, those are specific cases, nations with particular circumstances, economic instability, developing institutions, that couldn't occur in more established systems, right? Consider this. During fiscal crises, discussions about pension system restructuring emerge in policy circles. While specific proposals vary by country and rarely reach implementation, the fact that such conversations occur during times of stress demonstrates the pattern of governments viewing accumulated retirement savings as potential fiscal resources. The precedent has been established in multiple nations, and the mathematical pressures affecting pension systems continue intensifying globally. You won't believe which major economies have commissioned studies on pension system restructuring. The research findings are more extensive than commonly understood. Let's examine precisely how pension system mathematics create these pressure points, so you understand why this pattern emerged across multiple countries. Stage 1. The demographic trap. In 1950, when modern pension systems were designed, average life expectancy in the United States was 68 years. Retirement age was 65. Workers retired, collected benefits for approximately 3 years, then passed away. The system could sustainably fund that time frame. Today, life expectancy reaches 79. People retire at 65 and collect benefits for 14 years on average. That's nearly 5 times longer than original system designs anticipated. Combined with declining birth rates, from 3.6 children per woman in 1960 to 1.6 today, you have fewer workers entering the system while retirees draw benefits for longer periods. The ratio deteriorates continuously. By 2035, the United States will have 78 million people over 65 and approximately 140 million workers aged 20 to 64. The worker-to-retiree ratio continues compressing. Worker contributions increasingly fail to cover retiree benefits. Stage 2. The actuarial assumption challenge. Governments understand these demographic shifts. rather than addressing them directly. Many systems adjusted actuarial assumptions to make financial statements appear more favorable. When calculating pension liabilities, actuaries must estimate future obligations and discount them to present value. The discount rate chosen makes enormous difference. If you owe someone $100,000 in 30 years, using an 8% discount rate shows a present value of approximately $10,000. Set aside $10,000 today, assume 8% returns, you'll have the required $100,000 in 3 decades. But if actual returns average only 3%, you'd need $41,000 today to reach $100,000 in 30 years. The liability just quadrupled based on rate assumptions. U.S. state and local pension systems currently use 7 to 8% discount rates. Realistic long-term returns sit closer to 5%. According to Stanford researchers Joshua Rao and Kay Giesig, using market-appropriate discount rates increases reported unfunded liabilities from $1.6 trillion to over $5 trillion. $5 trillion of obligations not currently recognized in government accounting. Stage 3. The contribution shortfall. Even with optimistic assumptions, most systems aren't receiving adequate contributions. Between 2007 and 2024, state and local pension contributions in the United States doubled from 16% of payroll to 31%. That's a substantial increase. Yet the aggregate funded ratio barely improved, remaining around 80%. Why? Liability growth outpaces contribution increases. More people retire annually than enter the workforce. Investment returns consistently fall short of assumptions. The deficit compounds annually. Politicians face strong incentives to avoid raising contributions further because taxpayers notice. They can't easily cut benefits because retirees vote reliably. So many choose inaction, assuming future economic growth or future reforms will address the problem. This mirrors the logic underlying unsustainable financial structures. Assume new revenue keeps flowing, and you never confront insolvency. Stage 4. The restructuring trigger. Eventually, systems reach critical points. This occurs when financial crises cause pension fund values to drop 20 to 30% rapidly, as happened in 2008, or when interest rates decline substantially, increasing the present value of liabilities. When bond yields fell near zero during the 2010s, pension obligations expanded significantly. Or when demographic trends reach thresholds where contribution inflows can't cover benefit outflows. When triggers activate, governments have 4 options. Default completely, telling retirees they won't receive promised benefits. This is politically extremely difficult in democracies. Print currency, allowing inflation to erode the real purchasing power of benefits while nominal payments remain stable. This represents slow-motion default. Raise taxes or cut spending so dramatically that economic activity contracts severely. Or restructure existing pension assets, transferring private system assets to government control for immediate fiscal relief. The 4th option is what Argentina, Poland, and Hungary selected. They passed legislation nationalizing private pension systems. They framed it as protecting retirees, ensuring solvency, stabilizing national finances. They used terminology like reform, restructuring, sustainability. But the fundamental action was asset transfer. Private holdings became public holdings, and governments used them to address immediate fiscal needs. Stage 5. Post-restructuring outcomes. What occurred after these asset transfers? In Argentina, pension benefits were officially supposed to maintain previous levels. Adjusted for inflation, analysis suggests real benefits declined approximately 30% over the following decade. In Poland, the government claimed bond transfers wouldn't affect individual retirement accounts. Future pension calculations will reflect lower accumulated assets because the bonds backing them were cancelled. In Hungary, citizens were promised equivalent credits in the state system for private contributions. Government ministers subsequently announced those individual credits wouldn't be provided. Assets were absorbed into general revenue. The consistent pattern: short-term fiscal improvement for governments, long-term benefit reductions for retirees. When governments control pension assets, investment decisions become influenced by policy priorities. Assets get directed toward government debt purchases, infrastructure funding, budget shortfall coverage. The assets become politicized rather than managed solely for retirement security. Now let's examine potential future developments. because these demographic and fiscal pressures haven't resolved. The United States hasn't restructured private pension systems. However, the pattern observed in other nations suggests that when fiscal stress intensifies, governments explore various policy options for addressing pension shortfalls. Consider the scale. Americans hold approximately $23 trillion in private 401k and IRA accounts. That represents substantial capital. From a purely theoretical fiscal perspective, if national debt pressures became severe, these accumulated assets could be viewed as potential resources. This isn't a prediction, but rather an observation based on the precedents set in other countries where fiscal crises led governments to restructure retirement systems. Whether such scenarios could occur in different institutional contexts remains a matter of academic debate. This pattern extends beyond one nation. The UK has £1.5 trillion in private pensions. Australia holds $2 trillion in retirement savings. Canada, approximately 1 trillion CAD. Comparative analysis shows every developed nation, with aging demographics and underfunded public systems, has accumulated significant private retirement savings. The historical cases examined here demonstrate that during extreme fiscal stress, governments have restructured such systems, though the specific circumstances and institutional constraints vary considerably by country. Stage 6. The inflation alternative. Even without direct asset restructuring, governments can achieve similar effects through monetary policy. If you owe retirees $1,000 monthly and can't afford it, you could reduce nominal benefits. Or you could increase money supply substantially. The retiree still receives $1,000, but that $1,000 purchases less. You've effectively cut their real benefits by 20% without touching nominal payments. Since 2020, the United States increased money supply approximately 40%. Inflation has eroded real benefit values, even as nominal Social Security payments increased with cost of living adjustments. Those adjustments typically lag real inflation, particularly in categories like healthcare and housing that affect retirees disproportionately. This brings us to the core observation. Retirement benefits, whether public or private, represent promises. Promises depend on the entity making them having resources to fulfill them. Demographics create conditions where governments increasingly lack adequate resources. The question becomes how they address this resource shortage. Asset restructuring, monetary inflation, benefit cuts, or some combination. So what does this pattern teach us? First, recognize that this challenge is global and intensifying. Every developed nation confronts similar demographics: increasing retiree populations, declining worker ratios, unfunded liabilities measured in trillions. The potential solutions are politically challenging: substantial tax increases, significant benefit reductions, or extended periods of constrained government spending. These options face strong political resistance, creating pressure for alternative approaches. Second, understand that when similar crises affected Argentina, Poland, and Hungary, each experienced restructuring that observers might not have predicted years earlier. Middle-class Argentinians believed property rights protections were robust. Polish workers thought EU membership provided safeguards. Hungarians trusted democratic institutions would prevent such measures. Historical outcomes demonstrated that during severe fiscal stress, legal frameworks can change, precedents can be established, and restructuring can occur despite previous expectations. Third, economic analysis suggests the next wave of pension challenges could be broader in scope. When Argentina restructured pensions in 2008, global markets absorbed the impact. Poland's 2013 actions remained largely regional. But if major economies face similar pressures simultaneously in the future, the interconnected nature of global finance could mean limited external capital sources for relief. This represents a structural challenge that economists continue studying. How governments will address these challenges in coming decades remains uncertain. The patterns from Argentina, Poland, Hungary, Ireland, and Greece provide historical context, but they don't determine future outcomes. What individuals can reasonably do is understand these patterns exist, recognize the fiscal pressures facing pension systems, and make informed decisions about their own financial planning. Diversification across different asset types, geographic regions, and income sources is standard financial planning advice that becomes particularly relevant when examining these historical examples. The documented lesson from these 5 countries is that retirement security ultimately depends on individual preparation, not solely on government promises. They demonstrated that when governments face existential fiscal crises, system restructuring occurs even when it contradicts previous commitments. They framed these actions as necessary reforms, and whether that framing was accurate depends on your analytical perspective. So the concluding question isn't whether pension systems globally will face continued stress. That's already occurring. The question is whether understanding these historical patterns helps individuals and policymakers make more informed decisions. Are we learning from these documented cases, or will similar patterns continue repeating? If you found this analysis valuable, consider subscribing for more deep analysis into economic patterns and financial history. Share this with anyone interested in understanding how fiscal crises have affected retirement systems historically. The demographic trends and fiscal pressures discussed here are well documented by institutions like the OECD, IMF, World Bank, and academic researchers. Understanding the pattern matters, not for fear but for informed perspective. The mathematics of demographics are unchangeable. How societies respond to those mathematics remains to be seen. Thanks for watching.